Welcome to TMS Insights. Jeremy Hook and Ben Clark bringing you some news about reporting season, but a little earlier than we were planning because of the ructions in the markets in recent days. It's Wednesday morning, the 7th of February. We've had quite an interesting week so far, Ben, but it all started with that non-farm payrolls jobs number out of the US on Friday night. More than expected, which would be good news ordinarily, but it leads to potentially wage growth and inflation, which is interest rates going up, and the markets weren't entirely prepared for that.
Yeah, I think it's a case that the US economic data is just getting better and better and better, and it's sort of maybe hit a tipping point where bond markets really started to pay attention to it, and equity markets, that fed into the equity market. So yeah. It's a bond market, area that's really triggered all of this. The fourth quarter earnings season we saw in the US was outstanding yet again. So, and we still see a very positive case globally at the moment. But I also think, Jeremy, there's a reason people put behind a correction. Yeah. But I think it's more the case we just had to have a correction at some stage.
Well, there was some excess valuation and it needs a catalyst, doesn't it? And that's the one they chose at this stage, if you like you say. So 200,000 jobs, 180,000 were expected. Like you said, 4.1% unemployment in the US. At last, some wage growth. So that's good for the average American, but it's just how we position it. At the same stage, we've got a new Fed chair in Jerome Powell, and we're getting commentary there that we might see as many as 4 rate rises in the US this year.
Yeah, so 3 was the consensus leading into Christmas, which is what Janet Yellen was guiding the market toward. And I think there's a transition happening within the Fed, and maybe a slightly more sort of hawkish governor coming in, and we might see an acceleration in that. But as you said, I think it's been 14 consecutive months in America that we haven't had a 5% correction. Yeah. That's the longest stretch in the history of the US market. And as that record continued to grow, it just felt, I think, to both of us that inevitably we will get a correction, but when it comes, it's probably going to be a bit nastier than you normally expect because
it seemed like every journalist known to mankind was surprised by it and got very excited by it. So the front pages of papers and the lead stories on the nightly news were very much about the falls on the market. So 665 points down on the Dow on Friday, was down 1,500 points at one stage on Monday night, which became 1,100 at the close. But last night, having been down 600, actually turned right around and was up about 500 points, a massive turnaround. And so going into today's trade, we think things will possibly move on, at least initially, from that sort of volatility and back to what we want to talk about next, which is really the reporting season, Ben.
Absolutely.
And it's got underway with some interesting results already. We had just for yesterday alone, 2 very good companies give good results. We're going to talk now about Magellan Financial Group and Macquarie Group.
Yeah, look, I think so Magellan reported their first half result. This is a stock pretty much all clients would probably have a holding in the Magellan International Funds, the suite of funds. But this is the headline company that we're talking about, MFG. And I think we both feel this is a stock that clients could buy at the moment to take advantage of the recent weakness. A 26% increase in profit in the half. A very interesting announcement about the purchase of Airlie Funds Management. For those who don't know, Airlie was founded by John Sevier and Matt Williams, 2 of the most highly regarded stock pickers in the Australian market, and they have sold their business to Magellan to access the distribution network that Magellan have built up locally to start rolling out retail funds, etc., etc. This is a $6 billion FUM operation, which could grow significantly. Magellan's now at 53.
And I think, this is the point. Magellan is a global equities manager. It doesn't have Australian offerings for local investors. It will now through the Airlie acquisition, and the quality of John Sevier and Matt Williams and David Cooper is unequivocally accepted in our market. So I reckon that could go to, Ben, perhaps $20 to $30 billion within a few years' time, which would be a massive increase percentage-wise in Magellan's funds under management.
Yeah, and look, the thing Hamish Douglas has done a superb job. He's got a huge amount of skin in the game. The fact that John Sevier and Matt Williams are taking all Magellan shares for the sale of their business is a big endorsement of being a shareholder in Magellan from two of the best sort of stock pickers locally. But Hamish gave a great job on the call yesterday saying why Magellan's going to do so well over the next 5 to 7 years. And what he said there is that, over 5 years, we believe we can continue to grow returns in our international funds by, say, 8% per annum being conservative. So you've got a case, if you don't lose any clients, where that $53 billion they're managing at the moment grows by 8% and 8% and 8%. There'll be good years and bad years through that. Revenues will grow 8%. And then all of these things that they're doing, a la Ellie, is on top of that. So that gives you a rising revenue stream, a rising profit stream, rising dividend stream, and with the big correction we've seen in the share price the last few days, I think a good entry point as well.
Yeah, excellent. So and dividend is actually X on Friday, so you can get that if you buy this Wednesday or Thursday. So. The other one was Macquarie Group, and that wasn't a half-year announcement. It was a quarterly update and an operational advice to the market, and effectively was an upgrade now giving the market guidance of 10% earnings growth for the year, which is comfortably above where they were thinking previously. Didn't spare it in the market yesterday. It, like many other things, were down. It was down about 7%. An opportunity perhaps, Ben?
Yeah, I think so. Macquarie, although, I think people look at it and think, it's around $100, it's expensive. It actually, on its earnings metrics, it looks cheap, and it looks cheaper because earnings have been lifted and the price has fallen. It looks quite a bit cheaper than it did yesterday. And still pays a very good dividend yield. Very strong balance sheet. It's a much better business than it was pre-GFC last time.
And this was one of the most interesting things that we can certainly send around to clients. The slides that were particularly interesting was how they compared the growth in their annuity style of revenue businesses to their transactional market-facing businesses from 2007 to now. And it's really stark. And I think people would be anchored to the thought of Macquarie in those days, whereas in fact now it sits on a lot of annuity style income.
Absolutely. And Nicholas Moore, one of the interesting things he spoke about yesterday was if we are going to see rising inflation, it's actually a massive benefit to that annuity business because there's a lot of infrastructure assets that are tied to inflation, and these businesses will actually become more profitable if you do catch a rising inflation wave. So it's got to be one of the best managed investment banks in the world. It's like one of the things that Australia's done very well. And I think it's a buy at current sort of levels as well.
No, it looks terrific. This morning, pre-market, Commonwealth Bank delivered half-year results. The last performance by Ian Narev. And really, it was a bit light on, I think, Ben. I don't think we got overjoyed by that result.
No, sort of negative cash earnings growth. I think cash earnings were down about 2%. There were a series of one-off items, the Austrac case, provisioning for the Royal Commissioning, provisioning for the bank bill swap rate case. There's a lot of regulatory issues going on, but if you strip all of that out, you'd still look at the result and probably not get too excited. No. Dividend was up 1 cent, but they've had to lift the dividend payout ratio because earnings were down. Because earnings were down. So
$2 a share.
72% payout ratio. It's sort of higher than we've seen it for some time from CommBank. So I think it just highlights the. I would say, Jeremy, I hope you agree that the banks probably look cheap at the moment. The yields look attractive, but the outlook doesn't look great.
Earnings growth excites markets. It's not there at the moment. I would add on the positive side that the capital adequacy levels are stronger, and return on equity is still in the top level compared to banks globally. So not too bad, but certainly not exciting. What was pretty good also this morning pre-market was car sales. And they had a very good year in 2017, and you can see why with the earnings numbers they've produced there.
It's been, they've done incredibly well domestically. Those international businesses, I think this is something we'll hopefully see from SEEK as well, is that there's a big turnaround happening in these sort of developing economies where, they've got exposure, and it's been a bit of a headwind for them the last couple of years. It's starting to turn around. So great numbers from car sales. We've got REA reports on Friday. Which is the other widely sort of held stock there. And I think that stock's going to trade pretty strong today.
Agreed. Just bring it back to the market now. More settled markets likely today. Possibly we've been through that little storm. To my way of thinking, this bond market correction will probably cause a few waves in the front end of the year. We may get similar buying opportunities and short, sharp sell-offs while that process goes on, Ben.
Yep, keep having, I think we've sort of been saying for a bit of time now, have a bit more cash, as markets got more fully valued and no volatility. I'd agree with that. I think also keep in mind where we are in the cycle. The US market is in the 9th year of its bull market. It's quadrupled from its low. There might still be a few more years to go in this bull market. Things look very good globally, but we are toward the
it's
tail end.
It's a mature cycle, that's for sure.
Yeah.
So we have to raise our awareness of that and plan accordingly. Well, that's all we've got time for today. We look forward to bringing more updates through this February reporting season.